This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a full 5-day week, getting closer and closer to the sort of Diwali season, so to speak, but we're thick into the festive season, no doubt. We are coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, morning. Festive season, sporting action. India's doing well everywhere. So, I mean, no complaints, right?
Absolutely. Good win last night. We were challenged a little bit, I think, when we were batting, but happy the boys came out on top and, goes to prove that that we are not yet peaked out, which is good. I don't know about the markets, though.
Well, for the market, I mean, this week is important, right? You have the FOMC policy as well, so all eyes will be on that. And several domestic cues to reckon with, too.
Earnings are, in the thick of earnings, and so many earnings to actually react to this morning as well. But, as we always do, let's begin from the very beginning in terms of what you need to know as we start another fresh trading session. So I'll start actually with a quick line on Friday's session. Friday, we got a solid bounce. I mean, on the Nifty, Bank Nifty, broader markets, it was very good. And the point is we need to now build on it. We need to cross important levels. Conviction needs to come back above those levels. I'll get to the levels in a bit. I mean, so US markets on Friday, neither here nor there, more down than up. So especially on the equity side. So the S&P was down about 0.25%. The Nasdaq was up 1/3%. You had the Russell, which is the small cap index, which is in bear market territory in the US, which sold off another 1.2% or so. Yields were unchanged. The dollar was largely unchanged as well. We were at about 4.83. We were 4.84 on Thursday. Oil prices, they went up. I mean, about 2.5% or so. We are back above the 90-ish kind of levels. And the point is, it's all about geopolitics, the Middle East, escalation, etc. Those are the buzzwords around which oil market has been trading around. Now, the big global cue is, of course, the FOMC, the Fed decision. We'll only know that Wednesday night, and the market here will react to it on Thursday morning. The Fed is expected to basically leave rates unchanged in the month of in November. But the point is, if you can move the graphics along, what they say about what happens in the next meeting, the meeting beyond, I think those will be important in terms of what the Fed really wants to do. Now, let's just kind of circle back to our market here, right? The market on, as I said, Friday saw a decent, large bounce, solid bounce. What was behind the bounce? So you had... or rather, it's a question mark. What was behind the bounce? FII sold about 1,500 crores worth of stock. Local institutions bought only about 314 crores worth of stock. So the flows picture, at least on the cash market side, doesn't indicate very much by way of activity. I went back and looked at the index futures, what FIs did in index futures. And there as well, there isn't very much by way of a huge covering or anything. On Thursday, they were 1.5 odd lakh crore net short. And on Friday, they were about 1.52 lakh crore contracts net short. So, I mean, there isn't very much both on the cash side or at least on the F&O index side, which indicates what really happened. The difference, though, is on the derivative side, you get positions in terms of what everybody did, not just FIs, locals, clients, HNIs, everything. You get, four different segments in what they did. On the cash side, you don't get that. You only get institutional figures on a daily basis, which is what FIIs and DIIs did. So maybe from the HNI crowd, maybe from, other segment, apart from in the institutional segment, there was buying activity which came through. But from what we have, that doesn't really indicate that there was any large flow which came through from what is disclosed. Now, Nifty, just to circle back to the levels, needs to first cross 19,280. We left off at about 19,050. So the first level to cross is 19,280 as the first level. Now, what is that? That is the 38% retracement of the October fall, just the last 7-8 sessions fall. I'm not looking at the larger retracement from the all-time high to the low that we made on Thursday, because, let's take it step by step. So the nearest level is this 19,280 level, which is the October retracement level, the first October retracement. And of course, I mean, on the way down, the low that we made last week, which is 18,838, if that does not come into the play, I think that will be fantastic. The supports, as we highlighted all of last week and the week before that as well, stand at about in 18,700. We never got to those levels in the Nifty. We bounced from the 18,800 levels. So will be good not to see those levels come into play once again. The Bank Nifty needs a close above 43,055 and then 43,348. This is, again, the October retracement, the 38% and the 50% retracement of the fall that we've seen this month. Again, on the low for the Bank Nifty, which was 42,100, that should not come into play. And I think that will be a pretty good outcome. Broader markets, just a quick word, have actually recovered better, even better than the frontline indices. So the small cap index, if you take a look at the same retracements, is already above 50% retracement of the fall. Right? And not just the October fall, but from the all-time highs in the small cap index to the recent low. It's already retraced 50% of the fall. So, I mean, actually, the small cap index is once again exhibiting characteristics of being the strongest index out there. The mid cap index is just 1% away from the 38% retracement of the fall from the all-time highs for that particular index. So, I would actually say that the broader market is looking a little stronger as compared to what the frontline indices are doing. And within the frontline indices, I mean, the weaker between the Nifty and the Bank Nifty is the Bank Nifty. So that needs to do a little bit more in terms of work. The GIFT Nifty will come up on your screen. I think it's indicating a slightly lower start. 36 odd points or so in the red is what we have. So tentative kind of start, but hopefully we build on where we left off on Friday. Sonia.
I think it's going to be a tricky one, right, this week, because there are so many cues this week and the bias is largely on the downside. So even if you look at what, of course, the GIFT Nifty is suggesting that it'll be a 36-point cut this morning. But apart from that as well, on Friday, you had weak cues from the US markets. The Dow was under pressure. The big trigger to watch out for will be the US FOMC policy. The announcement comes out on the 1st of November. There is no rate move expected this time around, but because of the way the US 10-year yield has been shaping up, all eyes will be on the decision on the 1st of November. The US 10-year yield has largely been around that 4.88 mark. So, that will be very, very closely tracked, and that's the key trigger for the market. The Nifty, yes, it held on to 19,000 on Friday, but we need to see how much heavyweights can do to support the market because the bias is definitely on the downside. So Reliance is for one heavyweight, of course, that can support the market today. The earnings that came out on Friday were quite good. It was a stellar growth in the retail segment, stable growth in the telecom space, debt is lower, capex is funded by internal accruals, and the stock has been under pressure for a while. So there is some headroom on the upside. So that's one heavyweight that can support the market. Cipla is the other one that perhaps could see some follow-on buying today, although not a market heavyweight in the sense on the Nifty, but the company has raised their margin guidance. So, in that context, it could see some follow-on buying, maybe a rub-off impact on a couple of the other pharma names as well. In terms of earnings, you had very good numbers come in from the likes of Piramal Pharma, NTPC. So I'm going to be watching all of those stocks as well. But it's a very result-heavy week. So we start off with DLF, TVS Motor, Marico on Monday, that's today. And we end the week with SBI and Bank of Baroda. And that's the long list of, companies that are coming out with their numbers this week. A lot of nifty stocks, Bharti, L&T, Hero, Tata Motors, etc. So we have our hands full. But I think, the view, overall narrative is that this market is under pressure.
Yeah.
Yes, we've been holding on to 19,000 for now, but there is no real trigger which can sort of take the markets higher, in my opinion.
Well, that's right. Sonia, the long-awaited bounce had come about. I would have liked it to come on higher volumes, actually. The volumes weren't so high on Friday's trading session. But we got a bounce and, we did have to pop up from oversold levels. And that's precisely what happened. To look at the Nifty was good, but if you look at the mid-cap and the small-cap indices, they were up between 1.5% to around 2%. So the breadth of the market as well did do fairly well. I was looking at the, what did the FIs do? And we made this point on Friday, when the FIs go over-aggressive on the short side, it actually isn't such a bad thing. And even in Friday's trading session, they had very, very aggressive net short positions at the start of the series. And the last time that happened was in March, and we know April wasn't such a bad series. So the short positions actually didn't get covered out on Friday. In fact, they held on to those positions, and now in percentage terms, it's at around 88%. In absolute terms, it's around 1.5 lakh contracts. On the option side, overall, you have an equal number of calls as well as puts that are written right now, close to around 7 lakh contracts apiece. Now, we're looking at the strikes that were very, very active. The 19,200 call, well, that was very, very active. The premium of there's around 50 rupees. There appears there was some writing at that particular level. And on the downside, the 19,000 put, well, that added close to 25 lakh shares out there. The premium came down from around 200 to around, 80 odd. So just punching in those numbers, you're getting a broad range. The recent low, that comes at around 18,838. That's a bit of a support zone out there. On the upside, since the 19,200 call is getting written, you have the 19,250, which becomes a near-term resistance level. Beyond that, you're looking at the 100 DMA on the upside, and on the downside, you're looking at that 18,600 odd mark, which is a crucial technical level. The Nifty Bank, that did pop up and trade, but you'll require to see more of that. Right now, you're looking at the 200 DMA on the upside, and the recent low was at around 42,100 odd. The GIFT Nifty suggesting we pull back close to around 50 points. We're still in this range of close to around 400, 450 points approximately. If you want to see a decisive breakout, then we need to get past that 19,250. While on the downside, we'll have to breach last week's low to see further downside. So I think a bit of range-bound trade.
Okay, and the implied opening now is suggesting almost a 45-point card, so it doesn't look like it's going to be a very good start to trade. But let's kickstart and get you some opinion as well. We have lots lined up in the next 2.5 hours. First up on the equities front, Chetan Seth of Nomura says that they remain cautious and selective on Asian stocks against the backdrop of elevated geopolitical risks in West Asia and high and volatile US long bond yields, driven by a still resilient US economy, sticky inflation and treasury supply concerns. He thinks the longer the rates remain high, the higher the risk of a deeper slowdown in the US sometime in 2024, unless the Fed were to pivot prematurely. Against this backdrop, he thinks stocks geared to China's cyclical recovery may prove to be candidates for an outperformance in Q4.
Okay, well, let's get you some money market views now. B. Prasanna of ICICI Bank says that the ongoing risk-off sentiment continues to keep currencies on the edge against a safe haven dollar, with Asian currencies bearing the brunt. He says central banks of emerging market countries are seen fighting further depreciation of local currencies, and there is a remote chance of a hawkish surprise by the Bank of Japan in the next policy meeting. He adds the rupee, while seen having a depreciation bias on account of FPI outflows, oil buying and risk-off sentiment, continues to be supported by RBI and is expected to be between 83.1 to 83.6 to the dollar this week.
Okay, and on the bonds, V. Prasanna says global yields retreated from recent highs owing to strong investor demand, expectations of Fed pause and softening in crude prices. Back home, he says yields remain range-bound, awaiting announcement of the OMO sales. As system liquidity is expected to improve, he expects cautious approach to continue, with the 10-year benchmark bond yield ranging between 7.3 to 7.4%.
Well, a lot of stock-specific action to track for you. We get to that in just a bit from now in our special Top 10 segment. For the time being, we run you through the list. We're looking at Reliance, Ultratech Cement, NTPC, Cipla, MGL, and AU Small Finance Bank. All of them reacting to positive news flow. While on the flip side, you have Dr. Reddy's, BPCL, SBI Cards, and Mahindra Financials that could be reacting to negative news flow.